Hi friends, welcome to Adda 24/7. We are in the Sankalpa series for BFM. We are covering important theory, numericals, objective questions on in the same subject. Today we will be covering chapter number 7. Today we will be covering the theory part. Okay, so completely theory. Important definitions we will be covering, important points. Remember, theory is as important as numericals. Never underestimate the theory. Okay. See here, in Sankalpa series, we are covering not only this theory as well as we are covering objective questions, numericals of the complete topic as such. Up till now, we have covered up to chapter number 6. Now we are covering chapter number 7. So, follow the series completely right from the start. It is available on Officers Adda 24/7 YouTube channel. It is available as a this series as such. Okay. So, let's start. See here, the topic over here, 7th chapter is risk in foreign trade, role of ECGC. Now understand, risk in foreign trade. Remember, foreign trade means what? Whenever I am dealing with some foreign party which is not Indian. Okay? Whenever I am not dealing in India, I am dealing with foreign trade. So the problem over here is there are many risks, including country risk, there is a counterparty risk, there is a exchange risk, various risks are there. So first we need to know what is the risk actually. A risk can be defined as an uncertain event with financial consequences resulting in loss or reduced earning. Now understand this. Uncertain event. Suppose I'll tell you one important part about this uncertain event. Suppose if I ask you, everyone, okay, just answer my question now. Suppose if I ask you, somebody standing in front of a running train, okay? Somebody stands in front of a running train. Is there any risk involved? Yes. Is there any risk involved? Suppose if somebody stands tomorrow in front of a running train, is there a risk? Just type yes or no in the comment section. Yes. Many of you have typed this. Yes, yes, yes. It's not that. Here, risk means uncertain. Suppose if somebody stands in front of a running train, it's sure that the person is going to die, isn't it? There's no risk. Somebody is jumping from the fifth floor of a building. Is there any risk involved? No, because that person is surely going to die. If you are going to invest, now see here, these are the two examples. One more I'll give you. If you are investing in, let's say, some Ponzi scheme means what? Collect 3%, then again those 3% will collect another 3%, then you will get a commission. Right? You remember all those Ponzi schemes? That see my car, in 1 year I have brought this car, all this. Suppose if you are going to invest in that, it's sure that you are going to lose your money. There is no risk involved. Risk occurs when there is an uncertain event, whether it will happen or not. If that is the problem, then the risk occurs. Okay. So an uncertain event with financial consequences resulting in loss or reduced earnings. Here, that is important. There should be a loss or reduced earning. Only then it's called as a risk. Suppose if I'm investing in something where I'm sure that I'm going to increase my earnings. So in that case, is there a risk? No. Risk means two words important from exam point of view are uncertain and resulting in loss or reduced earnings. Got it, everyone? Now, second one. An activity which may give profits or result in loss may be called as a risky proposition. Here, which may give profits or result in loss. Now, both the things are given over here. Activity which may give profits or result in loss. What do you mean by this? Here, in earlier definition, what did we see? Uncertain event resulting in loss. So if it is giving me a huge profit, then it's not a risk. But a life issue is always in any project if you invest, the logic is very simple. High risk equals to, who can type? High risk equals to, who can type in it? High risk equals to what? High risk equals to high returns, right? High return, that is the basic rule. The one who takes higher risk will always get higher returns. So that's why the second definition satisfies this logic here. An activity may give profits or may result in loss. So it means if you are getting profits, definitely there will be a risk of loss. Otherwise, there can't be a profit. Here, I'll give you a simple example. If somebody is a salaried employee, okay, so what is the risk in that? Salary means every month you are going to get the same fixed salary. Like this FD, if I'm getting some returns, okay. But the businessman always, you see all the newspapers everywhere, you see the some good news about, or the this person has achieved 500 crores business, that person has achieved 1000 crore business. That is in business. Why? Because the risk taken is higher. Salaried person can never come in the newspapers or media. Why? Because that person is getting a fixed salary, and yet that person is earning on means living on that only. So if you take a risk, then only you'll have higher returns. So the activity over here is the same. The activity which may give profits may result in loss. May be called as a risky proposition due to the uncertainty or predictability of the activity or the trade in future. Right? So risky proposition, unpredictability. These are all important terms here. Uncertain and unpredictable. It means one and the same thing. Okay. So whenever we are talking of any higher risk event, then we are sure to get some higher returns if it succeeds. Right? Means we are seeing many startups now in India. What are the startups? These are risky propositions. But even out of 100, even one succeeds, like this Paytm, right? Even if one succeeds, then also it will cover all the losses of the investor. Okay? In human life, risk is related to illness, impairment, or loss of life. In commercial and business activities, the business profit or loss would depend on how business is run and how its affairs are managed. Isn't it? What did I give you the earlier example? Standing in front of a running train, jumping from the fifth floor. These are all related to human life. Isn't it? Illness, impairment, loss of life, right? Whereas in commercial space, what do we do? Commercial space means business. Business activity, the business profit or loss would depend on, see here, profit or loss, both the things are there. In any business, there can be a profit, there can be a loss. That's why it's called as business, isn't it? Otherwise, it would have been called as a job. Would depend on how the business is run and how the affairs are managed. This is very important. How a business is run and how the affairs are managed. Remember, any business, okay, if it is run in a disciplined manner, disciplined, very important, disciplined manner. Three things are very important in business, always, okay? That is called as CID. CID. What is CID? C is creativity. Creativity. You need to have a creativity every day. You need to have something creative, out of the box thinking. How should you increase the profits of that company? Some way or the other, you must always think ahead of the curve, ahead of the what your competitors are thinking. I is innovativeness. Okay, integrity. Sorry, integrity. Integrity means integrity towards your business. Integrity towards your business. So whatever I am doing, I must be thoroughly satisfied that I am doing the right thing. Okay, so that is known as integrity. And third is discipline. Very important. If you have discipline in anything, then you will definitely succeed. Okay, like you see the officers at the 24/7 videos. Discipline. Every day you will get the videos at this time, means this time only. You never lose out on this. So this is known as discipline. So creativity, integrity, and discipline. That is what is meant by this above sentence. It means that how would depend on how the business is run and how its affairs are managed. If somebody is not running the business properly, okay, what does it mean? Like we have many cases where the owners of the companies have run away, right? Kingfisher, we can name many, okay, all those PNB cases, right? All those. What are these? These all have run away. So this is not managed properly. The affairs are managed very poorly over there. So such businesses will never succeed. Okay. A risk can be defined as an uncertainty of an outcome. Uncertainty. It should always be uncertain. Okay. A risk in any occurrence, commodity or an object is due to the exposure in that particular currency, commodity or object. Now understand, we are coming to the next level now. Currency, commodity and object. Here we are talking of something else. Currency, commodity or an object. So a risk can be exchange of anything. Okay. Generally what happens, commodity and objects are exchanged for currencies. Always remember the logic in business is what? What is a business basically? What do we do in international trade? We either sell currency, commodity, right? Commodity, some goods, something, right? Commodity, then objects, mean object and commodity can combine, or we give the services. Either we sell the goods and commodities or we sell the services. And what do we get in returns? We get a currency, isn't it? Currency can be anything. I can call these as dollars, I can call these as rupees, I can call these as pounds, I can call this as anything. Okay. So risk in any currency, commodity or exchange is due to an exposure in that particular currency, commodity or exposure. What do you mean by this? Exposure in that. What is an exposure? Exposure means, I'll give a simple example over here. Suppose, let me remove all these. Exposure means what? Simple example over here is, suppose there is a huge supply of dollars today in India. Let's say huge supply. Nowadays, now what is the reserve, foreign reserve of India right now? Right now, foreign reserve of India is, anyone? Type fast in the comment section. Okay, just give me a rough figure. Is it above 600 billion or below 600 billion? That's it. Above 600 billion or below 600 billion? What is the Forex reserve today? It is above 600 billion. Okay, it's something around 620 plus billion. So it's a huge amount. Suppose, and the way India is growing, I'll tell you, I'm coming to this point. The way India is growing, what will happen? There'll be a huge inflow of dollars. So full dollars come in, only dollars come in. All the dollars are in. So what will happen? The supply will, what will happen with the supply? Supply will increase. Increase. If the supply increases, what happens? The rate of the dollar rate goes down. The dollar will be down, right? So right now it is at what? 80 rupees roughly, 85. It may go to 60 also within 1 or 2 years. So this is known as this exposure. Suppose if there is a huge increase in the supply of dollars to India, the dollar rate will go from 83 right now, 83, 84 roughly it is, to roughly 60 also. This level we can go to. Okay. So this is known as exposure. Now the exposure can be in dollars also, currency also, or commodity also. What do you mean by commodity? Okay, let me ask you a simple example. Do you know what is the price of water bottle, one that Bisleri bottle which we buy, mineral water? In India, it's 20 rupees, right? If you go for the same bottle in, let's say, Saudi Arabia or UAE, you'll get it at higher cost. In many of this Middle East countries, the petrol is cheaper than the water. Why? Commodity difference. In India, we have ample water going waste, pipe leakage, municipality pipe leakage, everywhere the water is just going here and there, right? In Saudi and Middle East, they don't waste water because they don't have water. Similarly, over here in India for petrol, have you seen anyone? We see all the farmers throwing their commodities or this vegetables on the road. Have you seen this somebody throwing petrol on the road? No, because that is scarce. So that is that is meant by exposure. Exposure means where either it can be huge supply or it can be scarce. So this will again affect the risk in that. If the supply is huge, definitely the rates of that commodity goes down. So somebody has invested in that commodity, that person will be at loss, isn't it? Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates on JIB and CIB from IIBF. Whatever IIBF gives you, latest update. Because what happens, IIBF in between sends some notification. And those notifications are difficult to understand. Remember, difficult to understand. So that's why these are explained. Updates are explained over here, not only given, they are explained. Okay. Second is you get free YouTube series, free YT series, free YT series. Okay. These free YT series means what? These free YT series are given means like what are you watching right now? You're watching this on BFM YT series. Similarly, you'll have for ABM, ABFM, BRBL. Similarly for JIB also. So that's why you're having the free YT series. So whatever is available free, subscribe to it first. See here, my funda is very simple in life. Whatever is available free, grab it first. Click on that bell icon. Click on this like button. Share it with your friends. Share it with your friends also, isn't it? It has no loss to you. So definitely share it because it's available at free, right? So that's why subscribe to this channel. Click on the bell icon right now. Like currency risk, commodity price risk, interest rate risk, etc. It is an integral part of international trade. See here, currency, commodity price, interest rate risk, it is an integral part. Means what? These are all the integral parts of the international trade. Whenever you are going for international trade, definitely you will see all these three risks arising. Interest rate risk. Here, I have discussed about the commodity, I have discussed about the currency, but I have not discussed about this interest rate risk. What do you mean by this interest rate risks? Here, it means that I'll give you a simple example. Just go and check on Google right now that rates, bank rates for USA or UK. UK, go for UK. That will give you a better picture. Bank rates for UK in 2022. Means check it for the whole year right now. 2 years, check it for 2 years. You'll see the difference. The interest rates in US and UK were going up since last complete 1 year. Now they have started falling down. But because of this interest rates going up, what happens? What is the other effect to this? As the interest rate goes up, what happens? The second point is the currency rate goes up. Look at the dollar. Dollar has risen. Currency goes up. Okay. This is a good effect for US from US angle. Good or bad, that's a separate aspect. Many of them argue that it's a bad for US also. So interest rate goes up, currency goes up, becomes stronger. But there's a negative impact. The GDP goes down. GDP. Okay, there's a positive impact. Inflation goes down. So as the interest rate goes up, inflation will go down. That is positive, isn't it? GDP down is negative, but inflation down is positive. So these are known as the interest rate risks. And prices of the bond, the prices of the bonds will go down. So that is negative impact. Price of the bond will go down. So these are all the 5 related elements. All these go hand in hand like this only, in this manner only. So that's why interest rate risk, it's an integral part of international trade. Bias risk. A seller faces risk relating to the non-acceptability, non-payment, quality acceptance, credit risk on the part of the buyer. Means what? Any buyer will give you some non-acceptability. I don't accept your goods. Now what happens? Imagine you have sent it from India to USA. Okay? This USA the goods are sent. And now the buyer over there says that I don't accept your goods. What will you do with those goods over here? You will have to bring them back. What is the cost? Huge cost, right? Bringing the goods back from such longer countries is not a joke. Okay? Distance, far distant countries. So, non-payment, somebody doesn't pay, takes your goods and doesn't pay. Quality acceptance, doesn't accept the quality. What will you do with such a distant country as such? If you are in India, you can definitely go through plane, train, anything, and you can definitely catch that person. But what about this? So on the part of the buyer, bias risk. This is known as the bias risk. Seller's risk. The buyer faces the risk. Now this is reverse, altogether different. The buyer faces the risk relating to the seller not shipping the goods after receiving the advance payment. May ship poor quality goods or may ship the goods after the considerable delay, which may lead to cancellation or delays in further orders taken by the buyer or even penalties in case of delays and non-shipment. Now, as we saw earlier, the buyer's risk means buyer not paying. Similarly, we can see over here the seller not sending the goods. Suppose imagine I am from India. Okay, I am from India over here. Okay, India, Bharat now we'll call it. I am from Bharat. Okay, now what happens? I am from Bharat over here and I am the buyer. I am the buyer over here. Okay, if I send advance payment to somebody, advance payment. Okay, let me write it. Advance payment. Okay, to somebody in, let's say, USA. Okay, USA. Somebody in USA. Now this person in USA, either there are 3 options now. I have sent advance payment. So this money is received by this person. Now this person, number one, does not send the goods. Does not send. Okay. Point number one. So then also I am at risk because I have sent the money, I have not received the goods. Further, why am I buying these goods? Because I have to sell it to someone, right? I have to sell it to someone. That's why I'm buying these goods, isn't it? I'm not buying this for consumption, right? Because we are in business over here. So does not send the goods. Number two, lower quality goods. Sends lower quality goods. Then also I'm at risk. Or third, sends delays. Means I'm asking this within a month and this person is sending me after 6 months. Who will wait for me in this world today? Nobody waits because right now it's a buyer's market. If you don't provide the goods right now, they will buy it from someone else. So look at this, what is given. May ship the goods after considerable delay, which may lead to cancellation of orders, cancellation or delay in further orders, because these are the further orders, or even penalties, isn't it? So that's why this is a seller's risk. Buyer's risk means what? I send the goods and buyer does not pay. Seller's risk means what? I send the advance payment and the seller does not send the goods, or sends lower quality goods, or sends the goods in with delay. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, everything. Whatever we need for clearing JIB and CIB, we get it over here. What do you need for clearing JIB or CIB? Either of them. You need only number one, lectures. So we are having online lectures over here. You need books. We have ebooks over here. You need tests. For why are tests needed? Tests are needed to boost your confidence. If you are able to solve it properly in the tests, so you'll be more confident when you go for the exams. Okay. So test. So everything is there. So what are you waiting for? Okay. Immediately download this app and start studying. Exams are not far off, dear, isn't it? Shipping risk. Now this is another type of risk. Shipping risk. Shipping risk means what? This includes risk arising due to other intermediaries in the international trade like shipping companies, handling agents, port authorities, local transporters, or even loaders, which may lead to delays or non-shipment of goods in time due to the variety of reasons like goods being mishandled, goods abandoned, goods siphoned off, goods wrongly delivered, goods delivered at another destination. So shipping risk means what's here? It can happen that buyer is good, seller is good, both are good. See, buyer has given the advance payment, let's say. Buyer has given advance payment, advanced, okay? And then buyer has given the advance payment. So seller over here has also sent the goods correctly. Exporter will call it, okay? Seller has sent the goods. But how to send the goods? The goods are sent via sea, either sea or air or anything. Tomorrow, if there is a hijacking of that sea, of that ship, or while putting the goods, they get broken. We see many a times in the courier, right? The same goods being mishandled. The articles which are received are broken. Many a times in courier, we have seen this. The goods get abandoned. Abandoned means what? They are sidelined somewhere. Wrong delivery. Goods of this person to that person to this person. This also happens in international trade many times because after all it's a human being, okay, or delivered at another destination altogether different. Means I'm telling them to deliver it. Let's say I'm Reliance company. I'm telling them to deliver at Chennai office of mine. They are delivering in the Mumbai office of mine. So yeah, delivered at the wrong distance. They are delivering at Reliance only, but they are delivering in Chennai office. I told you they are delivering in this Mumbai office. So that's basically shipping risk. Here, shipping risk involves any risk related to this shipping companies. The shipping company is not giving the proper documentation. Handling agents. Handling means these are called as this service agents we call them. Okay. So these agents. Then port authorities in many countries there are huge corruptions in ports. In India it has reduced. I won't say zero, but reduced. Why? Because everything is online now. EDI system. Okay. Local transporters, isn't it? Even after the goods reach the port correctly, but the local transporters don't do their job properly. Even loaders, right? those who load the goods on the ships. Okay, these handling agents are sometimes called as shipping agents also. Shipping agents. Okay, they manage all the goods right from your place to the buyer's place. So these can go wrong anywhere. So this is known as shipping risk. In the Sankalpa series for BFM, here we are covering important theory, numericals and objective questions. We are covering complete BFM topic for all these three aspects. So today we are in risk in foreign trade, chapter number 7. Okay. From yesterday we have started this chapter. So we are covering important definitions over here. Important definitions in the sense complete important theory, which may be asked in the exam. So here we are focusing on ECGC also, foreign trade also, various types of risks also. So today we'll be covering important risks over here. Okay, so let's start. Credit risk. Now, what is the credit risk? See here, always remember, credit risk means relates to the credit worthiness of the buyer, could result in non-payment of the export bills due to any reason like financial crunch, default, insolvency, and anything. Now understand, one important point about credit risk is always related to two aspects. Okay, one is a counterparty and second is this country risk. Okay, let me draw it over here. Credit risk will always relate to two parts. Okay, one is country risk, country, and second is counterparty risk. Counterparty, right? What do you mean by this? Country and counterparty risk. See here, firstly understand what is credit risk. Relates to the credit worthiness of the buyer, okay? Basically of the buyer, could result in non-payment of the export bills due to any reason like financial crunch. Now here the financial crunch is a typical question point given over here. Defaults, insolvency. Now all these points relate to the counterparty over here. Financial crunch of the counterparty, defaults by that counterparty, insolvency of that counterparty. Now, all these three aspects can definitely relate back to the country also. For example, I'll give you. Suppose if you have sold anything in, let's say, Afghanistan, any country, Afghanistan, okay, or North Korea, okay. What happens now? Even if your party is well off means if that party is ready to buy, say, give you the money, that party is good, financially that party is good, the transactions are good, everything is okay. But what happens typically, the country goes into default. Then also it's a risk. Because if tomorrow Taliban government says that no, nothing doing, no foreign exchange will go out of my bank from today. Even if your party is good, what will you do? Your payment is blocked, isn't it? This is a major problem for the country risk. This country risk has arose in many of the countries recently also. To name the few, all our neighbors, check all our neighbors, almost all. One is this Afghanistan, second is Pakistan. Look at this, what has happened. Look at Sri Lanka, what has happened, right? Means all these three countries, these are the major three neighbors of us. There is also Nepal, but Nepal doesn't have much foreign exchange as such. Okay, so these three countries will always have always been the credit risky countries, to be frank. Okay, because there is a huge country risk in this. Now counterparty means what? The country is good, but the counterparty is bad. Means your buyer is bad. Your buyer is not ready to pay. So this can be willful also. Suppose somebody is in USA, your buyer is in USA, your buyer is in Europe. So aren't the countries good? The countries are good. But what is happening? Your buyer is not okay. So that's why I'll tell you, credit risk will relate to two parts always. One is country risk and second is counterparty risk. Okay. So credit worthiness of the buyer. How will you check the credit worthiness of the buyer? It's very difficult to check credit worthiness of the buyer. So that's why we should always, to cover this credit risk, we always try to use one element. What is that element called as? We always try to use LCs, letter of credit. Through LCs, the credit worthiness of the buyer is bypassed. Okay. So in LC, what do? We give typical that bank gives us the responsibility, means gives us the assurance of payment on production of the documents, right? So that's why the credit worthiness of the buyer is gone and non-payment of the export bills by the buyer is gone. So typical credit risk is covered by LCs. Okay. LCs or even guarantees you can take. Guarantees means guarantees are also allowed. Okay. Financial guarantees. So they can be also allowed. So remember always, credit risk is always countered using LC or guarantee, or there is one more, but many of you might not know, but that is called as availization, similar to guarantee. Avail. Okay. Avail means giving a stamp on the bill of exchange. Suppose if this is the bill of exchange. Okay. Now here you are the drawer, you sell, seller signs it, right? Here the buyer signs it, buyer. But in availization, what happens? This buyer also signs it, and here on this bill of exchange, face of it, bank will sign it. Bank will say, I will pay if the buyer doesn't pay. So this is a third party assurance you are getting, and that also from the bank, good bank. Okay. So that's why this is known as availization. So to counter the credit risk, we always have these three things: LC, guarantee, and availization. Okay. Now second is legal risk. What is a legal risk? Look at this. Let me remove this now because this you have understood. Legal risk. So what is the legal risk? Understand this. Relates to any amendment in the laws of the seller's or buyer's country which could result in inability of the seller to export or of the buyer to remit the proceeds of the invoices. Means what? After all, this again relates to country risk. A part of the country risk. Here, country risk can have various parts. Country risk. It can have legal. Like as I said, just now I gave you this example of legal. Afghanistan. Taliban took over, and then it's their own laws which are going on. So relates to any amendment in laws of the seller's or buyer's country which could result in inability of the seller to export or of the buyer to remit the proceeds, isn't it? Means seller is ready to export, your party is good. But the problem is the country is saying nothing doing, no more goods to be sent outside this country, no more exports, so everything is stopped. Similarly for buyer, no more money to be sent, Forex to be sent outside my country. So that is also blocked. Okay. So country risk could relate to legal, or there are various risks in country. I'll give you this PESTEL. This is known as a typical risk analysis, PESTEL. Every country is always measured based on this PESTEL. Political, economic, social, technological, environmental, and legal. Always remember this. PESTEL analysis is done for each and every country before doing any business with them or investing in any country like this. Okay. So this is a typical one. I'll give you one more example in legal risk. Suppose if you go in many of the Middle East countries, the checks which we have, checks in India, checks are typically for how many months? Maximum 3 months, right? Beyond 3 months, you can't use those checks in India. But in some of the Middle East countries like UAE and others, you have those checks which are being used for almost 2 years also. Because that is a legal process, legal system, right? In India, you can take the collateral, right? And nobody stops you. Suppose in some Middle East countries, the collateral is, if it is to be taken, how can you take it if you are a foreign bank over there? You can't take it because there the laws are different regarding the property. So it depends on those laws. Okay, that's why it's called as a legal risk. Means whenever you have to enter any country for doing any business, you have to typically be sure that what are the legal problems in that. Okay. So legal risk continued. This could be due to the embargoes on the countries, ban, restrictions on the export of a particular goods, ban, restriction on remittance of funds to particular country. Now I'll tell you one thing like ban. What is ban or restriction of export? On export. Look at this. Recently, India had banned this import of all these laptops, foreign made laptops. Also export, I'll write it over here. Here, import of laptops was banned by India, right? Import. So this is again a legal risk. Import of laptops. Okay. Similarly, export. We have banned what recently? What have we banned? Can anyone tell me? What is the export which is banned by India now? Recently. Rice, correct. Rice is banned. Second, wheat is banned. Wheat. Okay, wheat is banned. Then third, what is banned? What is India banned? Many of the things are there. Onions have been banned now. Onions. These have been banned. So these are typical bans which arise within that country, which the country gives these bans. So embargoes means stoppages on the countries. Ban restrictions on export of a particular goods, ban restriction on remittance of funds. Okay, so funds transfer, like I gave you the example of Taliban, right? So these are typical examples of legal risk. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will get the latest updates from IIBF explained. Okay, updates from IIBF are explained over here, latest ones. Okay, so what is the point is, many of the IIBF notifications which come are very difficult to understand by common banker. So they are explained it over here. And second is, you get free YT series, YouTube series. Okay, free. So whatever is free, I would suggest grab it fast, isn't it? Now similarly, see here, right now you are watching BFM YT series. Similarly, you can have the YT series on, you will be having it on ABM, for ABFM, for BRBL, all the 4 subjects by different mentors. Similarly for JIB also you are having it, right? So subscribe to this channel, click on the bell icon, click on the like button, share it with your friends. Do it fast. Because remember, sharing is caring. That is very important. Okay. Country and political risk. Now, what do you mean by this here? Just now we saw some part of the country risk, but again we'll see the political risk now. It relates to the development in the country of the buyer or seller leading to default in export or payment. So developments in the country. Developments means these developments are always dynamic. Remember. Or buyer leading to default in the export or payments. Okay, so developments can be dynamic, means suppose if the government changes in many of the countries, so immediately there are bans, right? Similarly, for example, right now in US, what is happening? They are coming up with the elections, right, in 24. So now the new candidate has told that he'll put a tax on India. Donald Trump, he has told that he'll put a tax on India if he comes to power. What is this? This is the intention of the political risk, right? Some other countries have also done the same. Means China is generally is not a good friend of India. So it always tries to put some taxes, something on Indian goods, right? So these are all political risks. There are also friendly countries as such, like in UAE for India. They are typical friends. They have allowed freely everything. Okay. So relates to the development in the country of the buyer or seller leading to the default in the export or payments. This could be due to uncertainty in laws, right? Uncertainty in laws. Uncertainty in financial position of the countries. Remember, financial position of the countries. This is typical. Okay. Discordant relationship between the countries or fluid political situation. So discordant relationship between the countries means friends and foes. Means going against each other. Okay, discordant means cross relationship. And fluid political situation. Fluid means what? Like if you see this fluid political situation, I'll give you a typical example. In many countries, like for example, in this Israel, if you check Israel country, they have so many elections. Every 7 months, they are nowadays having the elections, and the government changes. So that is fluid situation. If you go typically in South African countries, typically, their government changes every now and then. So that is fluid political situation. Okay. So fluid means what? Very fragile political situation, right? So developments, uncertainties in law, financial position of the countries, and discordant relationships. These are the typical risks. Okay. Let me come to few more. Countries' weak forex reserves position could lead to the shortage of foreign exchange or inability to buy foreign exchange, resulting in externalization issues. Now, this is a typical and this needs explanation. Weak forex reserves. Okay. Okay, just tell me one thing. We'll compare. We are neighbors over here, India and Pakistan. We'll compare India and Pakistan. Okay. So now, India will say Bharat now. India is not India. We should say Bharat now because how can a country have two names, isn't it? So Bharat. Okay. So now, let's say in Bharat, what happens? Countries weak forex reserves. Look at this point. Right now, what are the forex reserves of India? Anyone knows? Anyone idea? Any idea? It is 600 plus billion. 600 plus billion. Okay. 600 plus billion. What are the forex reserves of Pakistan? Roughly 7 to 8 billion. 7 to 8 billion. Where is 600? Where is 7 to 8? So this is known as weak forex reserves. World Bank says here every time World Bank has given, and in fact IMF has given a simple rule. IMF says that which country is stable country? Which country do we call it as stable country? The stable country definition they have given, any country whose forex reserves are sufficient for next 9 months for imports. So that country is called as stable. Okay. Now look at India's 600 plus billion reserves. Every year, every month, India requires around. This is what the general whatever is found is around 40 billion for imports. Every 40 billion per month. Okay. Now we multiply it by 9. 9 4 is 36. So 360 billion we require for 9 months. Right now, how much are we having? 600 billion. So we are much more than the stable. We have a best rating. That's why India is having nowadays, and this rating is very high for India. Okay, and it is going up constantly. So important point always remember over here. Countries' weak forex reserves will always lead to shortage of the foreign exchange and inability to buy foreign exchange, resulting in externalization issues. Now look, if you look at the inflation, if you look at the typical inflation, then what happens? If you look at the inflation, okay, inflation in Pakistan has rose heavily. Similarly in Sri Lanka rose heavily. Why? Because less of the forex reserves. Okay, this less forex reserves always leads to high inflation. So this is a typical reason. Got it? So that's why any country's forex reserves will lead to a problems of inflation, political problems, legal problems, social problems. All these problems here. After all, it's money. If you don't have money, nothing can means you can't play games with money. Either you have this money or you don't have the money, isn't it? Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, everything. Whatever you need, you will get it over here. Okay. Operational risk. Operational risk relates to operational issues at both ends or even at the supporting organization's place. Means what do you mean by this? Both ends. What are the both ends? There is a typical here. Let's look at every export or import transaction. There is a typical exporter, right? From any country it is. Then second we have typical importer. The one who buys, right? Importer. Now the in between, how will the goods over here should reach from the exporter to the importer, right? But how will they reach it? It reaches through supporting organization, means shipping company. So shipping company. Okay, shipping company. So this is known as the third party or shipping the supporting organization. relates to the operational issues at both ends or even at the supporting organization's place. Means if the exporter is having some problem, then that exporter won't be able to ship the goods. If the importer is having the problem, the importer won't be able to give the funds, right? Funds back, because funds should be received from importer. So importer won't be able to give the funds, right? Then strikes at the seller's factory. So this can also happen, strikes at the seller's factory or even seller's raw material supplier's factory. So if exporter is getting some raw material from somebody to prepare the goods, right? So somebody is supplier to this exporter also. So if there is a strike or some problem with that supplier, even then raw material will not be received. So exporter won't be able to export, manufacture and export. Then this raw materials suppliers, transporters or loaders or banks or clearing agents anywhere. Even if there is a strike in the shipping company, there's typical strike over here, then also it's gone. You can't do anything in that case. So that's why operational risk relates to in any ways if you can't give the service. It can be due to strike, it can be due to dacoity, it can be due to terrorist attack, it can be due to floods, anything. Okay. Similarly, operational breakdowns or failures of systems, connectivity and communication, disruptions, commotions and other strikes or errors of by operating staff could lead to non-shipment or delay in shipment, shipment of defective or damaged goods, delays in making payments or receiving payments. So anything which relates to the stoppage of any transaction. So what are the transactions over here? Look at this. Failures of systems, connectivity, communication. So if there is no communication, how can you communicate with that guy in USA? Okay. Disruptions, commotions and other strikes, errors by operating staff. Errors by operating staff is also an important part. Huh? Error of commission and omission. We had this in your JIB, right? So these errors can also lead to huge problems. Could lead to non-shipment, right? Delay in shipment, shipment of defective or damaged goods, delay in making payments. Here, delay in making payments, when does it happen? Suppose if the documents received by the buyer or the exporter are defective, documents are defective, or under the LC, the issuing bank receives the documents and those documents are with errors. So that issuing bank won't pay. So that will lead to the delay in payments. That is also a problem over here. So delays in making payments, receiving the payments, everything. So what a operational risk typically, as I told you, relates to if I can't service the customer, whatever service I am giving, then I am. Hi friends, welcome to Adda 24/7. We are in the Sankalpa series for BFM, and here we are covering important theory, objective questions and numericals. Today we will be covering the theory definitions. Last 2 days we are covering the definitions, but 3 days in fact. But these are important theory questions from your exam point of view. Definitions means not only definitions, we are covering the important theory behind those topics. Okay, so follow the series completely. Okay, from tomorrow we'll be covering the objectives and numericals on the same chapter. So presently we are in chapter number 7, risk in foreign trade, role of ECGC. Okay, so let's start. See, exchange risk. What is an exchange risk? Here, exchange means what? When will exchange come in picture? Exchange will come in picture whenever you have one commodity and it is exchanged against the other. Okay. Suppose if I give you some dollars, okay, and I take some money from you, then it's an exchange. What is the sabji wala? Vegetable vendor. What is the sabji wala business? Sabji wala business is same as that of the Forex business. No difference. Sabji wala gives you the sabji, you give him that rupees, right? Similarly in dollars also, somebody gives you the dollars, you give them the rupees, or you give them the dollars, they give you the rupees. It's that simple, isn't it? So exchange risk arises when you have two or more commodities, Huh? See here, it's called as commodities. Rupee is also commodity, dollar is also commodity, everything is commodity. Two or more commodities you have, which are to be exchanged with each other. That's why what happens? The rates are to be fixed. How do you decide on the rates, right? So that is decided by the market, buy and sell. Okay, demand and supply forces. So exchange risk means relates to adverse movement in the currencies. Here, typically we are talking in Forex. So it will relate to Forex. So commodities here means two commodities will be there. Roughly, let's say. One is dollar and second is rupees. So these are the two commodities. Okay, so relates in adverse movement of the currencies. What do you mean by adverse movement? Now see here, I am talking of risk. Risk means it's adverse movement. For example, I'll give you a simple example. Suppose if I brought a dollar, okay, let's say I brought $1. Take one example only. I brought $1 for 80 rupees. Brought, this is what I have brought. And now this dollar rate goes to 85. So am I at risk? Just type yes or no in the comment section. I brought $1 at 80 and now I am having this rate as 85. So I brought it and kept it with me. Now the rate is 85. Am I at risk? No, I am not at risk because the dollar is favorable to me. This is known as a favorable position. Favorable. So what is unfavorable then? I brought it at 80 and now the dollar goes to 75. Now that is unfavorable because I brought it at 80 and now it is at 75. So this is unfavorable risk. This is the risk. See here, that's why it said relates to adverse movement in the currencies. If it's a favorable movement, then it's not a risk. Okay. Any exporter or importer faces exchange risk directly or indirectly. Obviously. What do you mean by this? Okay, I'll explain you. Okay. Any exporter or importer faces exchange risk. Means what? Exporter means what? What is the exporter? Exporter means that person who has sent the goods outside. Now that person will be getting the money. Okay. So if that person gets money and the dollar rate changes, then the amount of rupee which that person will be getting will also change. I'll explain this. See this. We are having this second slide. We are having this. I'll explain it over there. Okay. So invoicing in the currency other than home currency. This is also a typical exchange risk. Suppose if I am in India and I invoice somebody in rupees. Invoicing means what? Giving the bill. Invoice means bill. I am giving the bill typically in rupees to this any person. So what will that be? That is no risk at all. Suppose if I am giving an invoice, I am giving you a bill tomorrow, let's say. You pay me 100 rupees, let's say, and I give you some service. So that 100 rupees, whether the dollar will rise or fall, this 100 rupees will be 100 rupees, right? Directly. So invoicing in other currency, if I give you the bill of $100 and then what happens? The dollar rate changes. Then I'm at risk. Why? Because I have to convert ultimately the dollar into rupees because I have to deal in rupees over here. So invoicing in the currency other than home currency is also related to the exchange risk. Other than home currency, okay? Got it clear? Strengthening and weakening of a currency in which imports are built. Now look at this. This is typical question over here. Strengthening or weakening. I told you I'll be explaining you this effect of currency. See this. Look at this. Weakening of a currency, good for the exporters, indirect rate. Now what do you mean by all this? If this sentence you understand, you will understand many concepts automatically. What is direct rate firstly? What is direct rate? Direct rate means $1 equals to rupees 80. This is direct rate. What is indirect rate then? Indirect rate is given in terms of GBP. 1 GBP equals to $1.5. Here dollar is fluctuating in indirect, and in direct this is direct. In India we follow the direct rate system, and in GBP they follow indirect rate system. Okay. Now the days are not far off when we Indians will go for indirect rate system because dollar is falling down. It will fall down in some years to come. So weakening of currency, good for exporters. Now what do you mean by this? Let's forget this indirect rate for time being. Let's focus on this only. Weakening of currency means what? $1, if I have to buy $1, I have to give 80 rupees. Now weakening of currency means weakening of rupee means what? So $1 will be costing weakening of rupee. Now rupee is weakened, so it will be rupees, let's say 90. For buying 1 kg of potato, I had to pay, let's say 80 rupees. Now for purchasing that same 1 kg of potato, I am paying 90 rupees. So what has happened? This potato has become expensive. It has become stronger, expensive, right? That's why I have to pay more amount. Similarly over here, the dollar, $1 for buying $1, I have to pay 80 rupees. Now for buying that same dollar, I have to pay 90 rupees. So dollar has increased or strengthened. So this has strengthened over here, strength. And importantly, this 90 means this has weakened. This is weak now. So now look at this. Weakening of a currency is good for the exporters. Why? Why is it good for the exporters? Let's say I'll give you a simple example. Okay, let me remove this indirect rate now because that is not needed for you. Let me remove this, okay, over here. Okay, so now, suppose if I bill you, let's say, I send you some, let's say 100 chairs or 1000 chairs to you in USA. Okay, and now what happens? I bill you, let's say $1,000. So you will give me, you as a buyer will give me $1,000, right? What will I do as an Indian person? I have to stay in India, so I need rupees. So I'll convert this. So 1000 into 80, how much will I get? 80,000. I'll be getting 80,000 rupees. Now what happens? Rupee weakens. So again, you will be paying me $1,000 only. So what will happen? How much will I get? I'll be getting 90,000 rupees. So if I sell it in the market and then convert this dollar to rupees, I'll be getting 90,000. Earlier I was getting 80,000. So it is good for the exporters. Always weakening of a currency is always good for the exporters. Always. And vice versa, reverse thing. Suppose let's say this same thing happens and I am the importer. Here, this was for exporter, typical. Okay, exporter. Okay. Now let's consider the same case, reverse case. I am buying something from you. Okay, and you are charging me $1,000. Okay, for those $1,000, I have to give you 1,000 now because I'm buying goods. I'm the importer. So in importer, what happens? Earlier, I used to pay 80,000 rupees for buying this $1,000, but now the rupee has weakened. So I'll be paying 90,000 rupees for buying the same 1,000. So I'm paying more. So it is bad for the importers. Bad. Okay, for importers. Always remember, it is bad for the importers. Got it? Typical. So this is a basic logic behind weakening of currency and strengthening of currency. Weakening of currency is always good for the exporters, and strengthening of currency is always bad for the exporters. Okay. So this case, see this is weakening. So it is good for the exporters and bad for the importers. Clear? Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates explained on JIB and CIB from IIBF, because IIBF gives you various notifications. Okay, so these notifications are explained to you, not only given but explained also, because they are difficult to understand. Many a time many of the bankers don't understand what is it trying to say. So one, you get latest updates, very important part, updates. And second thing, what do you get? Updates. And second thing, you get free YT series, free YouTube series. Right now, what are you watching? You are watching the free YouTube series. Similar YouTube series, you get it for this ABM, this BFM, ABFM, BRBL, all the 4 subjects. Okay, so that's why subscribe to the channel immediately, Officers Adda 24/7. Click on the bell icon, click on the like button. Okay, then share it with your friends. Okay, policies of ECGC. Remember, here ECGC, this chapter typically is related to risk as well as ECGC. What is ECGC? Export Credit Guarantee Corporation. Now remember, I'll give you one typical point about this here. Now it is called as ECGC Limited. ECGC Limited it is called as. Now, if I ask you really in legal way that ECGC, if I ask you what do you mean by ECGC Limited? So you shouldn't say it is Export Credit Guarantee Corporation Limited. No, It is only ECGC Limited. They have removed its full form. So ECGC Limited is ECGC Limited. It was called, formerly it was called as Export Credit Guarantee Corporation. Now it is a separate company. Okay. So, but it does the same job. Okay. It gives the insurance. What does it do? Export Credit Guarantee Corporation. Export Credit. So typically okay, I'll write the full form also. Export Credit Guarantee Corporation. Okay, that is ECGC. Okay, actually see this is full form is the earlier it was called as Export Credit Guarantee. Now it is called as ECGC Limited only. So what does it do? It does credit insurance. Here there are two policies or two things which are given by ECGC. Typical. One is policies and second is guarantees. See, both the things are given. Policies are given for the exporters. Let me see here. Now you know the name. Shall I remove it? Everyone? Type yes in the comment section if I remove this ECGC Export Credit Guarantee Corporation name. Remove it. Okay. Yes. Okay. I'll remove it. See this. So, see here. It gives, ECGC gives basically two types of policies, you can say. One is for the bank, ECGC. One is for the exporter. And second is for the bank. Okay, bank. Now for the exporter, it gives policies. See this. Exporter, it gives policies. Always remember this. It gives policies for the exporters. And for the bank, it gives guarantees. Okay. It gives guarantees for this export banks. Okay. Now what are these? Understand, you firstly got this exporter, they give the policies, bank, they give the guarantees. That's it. Now we'll study what is policy and what is this guarantee. See this, policies for ECGC. A credit insurance policies are given to individual exporters to cover the risk of non-payment by the buyer of goods or other events. So typically, why does the buyer need an insurance? Why does the seller need an insurance? The seller needs it because if the seller sends the goods and the buyer doesn't pay, then what? You'll say then typical LC is there. But LC cost me higher than the ECGC policies. ECGC policies are always cheaper than the cost of the LC. This is, ECGC is always taken on collection basis or open account basis. There are 4 methods of payment. Who can tell me what are the 4 methods of payment in international trade? Always remember, tell me which are the 4 important methods of payment. One is, shall I write it? Okay. First is, let me see if I can write it over here. Hold on. One is advance payment. Okay. Advance payment. Second is open account. Now see this, these are typical terms and these are very difficult. It will take a lot of time to understand. I have explained this in my earlier lectures. Advance, open account, then there is collections. And last one, it is LC. So these are the 4 methods of payment. So ECGC is generally applicable to these collections and open accounts. Typically. Okay, because in both these things, the seller is at risk. Advance payment, buyer is at risk. LC, bank is at risk. Okay, so policies of ECGC. So credit insurance policies are given to individual exporters to cover the risk of non-payment by the buyer of the goods or other events. Other events means anything can happen in this world. Political instability, like what happened in this Afghanistan. Taliban took over. Suppose if you have sent some goods to Afghanistan, then the payment won't be received because Taliban had stopped the Forex currency movement from the country for some time. So that is known as policies, means exporter's risk. So exporter is always given the policy. What about the guarantees? See this, insurance cover or guarantees of ECGC. So guarantees are given to the financing bank to cover the risk of non-payment by the exporter or the drawee of the export bills. Okay, financed by them. What do you mean by this? Okay, let me remove all these things. Now you have already know this. So now insurance here. What happens with the banks is, if bank gives me here, let me explain you this. Suppose let's say I'm the exporter. Okay, I'm the exporter. E over here, exporter. Okay, I've sent the goods. Goods are sent out. Goods. So I'll be receiving the payment. But for manufacturing these goods, I need some loan. So bank gives me the loan. So bank gives me which type of loan? Bank gives me pre-shipment or post-shipment, both, right? Pre or post. Okay. And then what do I do? With pre-shipment, I manufacture the goods, then I send it, and then I take the post-shipment. And then I convert this post to pre to post. Okay. Now the typical problem over here is, if I as an exporter don't get the money for these goods, this buyer in USA, UK, wherever the buyer might be, the buyer does not pay me. So what will happen? Even I can't pay to the bank. So what happens? This loan becomes NPA. So now to cover this NPA, to cover this relationship between bank and the exporter, here the in guarantee part, it has nothing to do with this importer part over here. It is only concerned with the bank and the exporter relationship. So this insurance cover are given to the financing banks to cover the risk of non-payment by the exporter. Non-payment. So if I don't pay as an exporter, then bank will be at loss. So bank gives a typical insurance, gets a typical insurance on this part. And this is known as guarantee from ECGC. If any of the exporter does not pay to the bank, does not, in that case, bank will get the money from this ECGC. This NPA can be removed or reduced by using the ECGC policies. Okay. Yeah. See here, it's typical. See, if the exporter does not get the money from the buyer, the exporter won't be able to pay to the bank, right? Pre-post cannot be closed. So that is a typical thing. Okay. Shipping risk. This includes risk arising due to other intermediaries. Means what? Other intermediaries. What do you mean by this? Other intermediaries means here there are two parts, basically two parties in any business. One is buyer and second is seller. So seller sends the goods to the buyer, right? And then buyer gives the payment. Now what is shipping risk? See here, seller will send the goods through what? The seller will send the goods either through ship or through road, means truck, anything. Then trains, airplane, air, right? Any of these. So any of these, the goods can be mishandled in this, right? The goods can be broken. See here, arising due to other intermediaries in the international trade like shipping companies, handling agents, port authorities, local transporters, and even loaders. Loaders mean those who load the goods, which may lead to delays, non-shipment of good in time due to variety of reasons like goods being mishandled, broken, goods abandoned. Abandoned means kept aside and then forgot. Everyone forgot about those goods. Abandoned. Goods siphoned off, robbed. Siphoning means robbing. Theft, burglary. Goods wrongly delivered means they were to deliver to A. Now they have been delivered to B. Someone else only. So this is known as wrongly delivered. Goods delivered at another destination. Again, it means wrongly delivered. Okay. Another destination typically means what? Say, it means that suppose if I told you, suppose if I am the importer, I have told you that what you do, you send the goods to my Mumbai office. Okay. And you are the exporter. What do? You send it to my Chennai office. Now bringing the goods from Chennai to Mumbai is not a small task because you know the distance. So this is delivered to a wrong destination. So that is basically shipping risk. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. What all do we need for clearing CAIIB? We need classes, we need books, we need tests. All the three are available. So that's why download it right now. Okay. What is maturity factoring? This is a typical topic. Tomorrow I'll be taking this. Okay. Factoring, I'll be dealing with this because this is a bit difficult topic. I'll be dealing tomorrow in factoring and forfeiting. Okay. A guarantee scheme under which the factor pays only on the due date of the export receivable and not at the time of drawing of the export bill. Okay. So the factor pays, see this, factor pays only on the due date. Factor means what? This is typically the bank. Typically the bank. Bank pays only on the due date of the export receivable and not at the time of drawing the export bill. Drawing means drawing the export bill. It means whenever bill is drawn, written. The financing of the bill is done by another financer on its strength. Okay. So maturity factoring is different. See here, maturity factoring means this is a typical case of factoring. Factoring means what? Simply factoring means financing this customer. Open account. Generally factoring is done on open account basis. So financing this customer immediately means it is financed immediately. When the bill is drawn, at that time only it is financed. And maturity factoring is typical part of factoring in which the factor pays only on the due date of the export receivable. Remember this maturity factoring name itself means payment on the due date. This is a typical exam question. I'll be explaining factoring tomorrow. Okay. We are in the Sankalpa series for BFM. In this, we are covering important theory, objective questions, as well as numericals. Today, we will be covering the objective questions. The chapter number is 7th. Risk in foreign trade, role of ECGC. Up till now, full last week, we have covered the theory part, means all the important definitions and important terms over there. Okay. So, let's start. Let's start the objective questions now. Now look at this. Typical ones are there. Huh? These are very typical ones. A beneficiary of an LC wants that the pre-shipment credit should be available to him on strength of the LC. Which of the following LCs will be suitable to meet this requirement? Now firstly understand what is pre-shipment credit. Okay, many of you might be knowing this, but then also pre-shipment means what? Here there are two types of finances always. One is pre and second is post. Pre, second is post. Okay. Pre-shipment, post-shipment. This is also called as packing credit. Understand this. Packing credit. This is also called as that. Okay. So pre-shipment, I'll write the shipment also. Shipment. And that is post-shipment. So always remember, pre-shipment is always given for manufacturing of goods, mainly manufacturing for raw material, everything. Okay. Labor, raw material, electricity, running cost, everything. For that, this pre-shipment is given. Okay. It is given up to the time the goods are loaded on the ship. Means what? Suppose here, I am the manufacturer over here. Okay. Then I've got the order from some US, right? So I've got this order. So once I get the order, I need to manufacture these goods. For manufacturing, if I don't have money, I take money from the bank as a finance. So this bank will give me a finance. Bank. Okay, it will give me a finance. So after that, I'll manufacture the goods and then I'll ship it, load it, right? Load it on the ship. So once I load it on the ship, here my pre-shipment gets over. Here my pre-shipment is up to this part only. From here, post-shipment starts. Okay. What is the percentage of pre-shipment? So that is 75% of the FOB value. What is the percentage of post-shipment? 100%. So now the question is, if I want this pre-shipment finance, okay, then in that case, what type of LC should be available to me? Which of the following LCs are suitable to meet this requirement? Now that is the question. Now what are the types of LCs basically? That also you need to understand. Okay, let me remove this now. You have understood this? Let me remove this. Now look at this. It's called as back-to-back, red clause, green clause, and transferable. Now what is back-to-back? Back-to-back means what? See here, this LC is available, means it's made available on the basis of the earlier LC. Now what does it mean? It means that suppose if I have received this LC, suppose this buyer in USA has given me this LC, issued an LC in my favor, beneficiary. Okay. So what is this? There is a bank called as advising bank. This bank acts as a this transferring bank also. So this is LC number 1. So on the end, I am the beneficiary over here, seller over here, seller. So here I am an agent. I am not a manufacturer. Okay. Here I am an agent, not a manufacturer. So in this case, what happens? When I get this LC number 1, so there is a transferring bank over here, transferring, or we call it advising bank. Okay, advising. So based on this LC, if I have to give, I am an agent. So if I have to give the order to someone else further, okay, third party. So I can call it sub-seller or sub-exporter. Okay, sub-seller I'll call it. Simple word. So based on my original LC, this advising bank will give me a second LC in the name of this sub-seller. That is known as back-to-back. What is this transferable? Transferable LC means this first LC, see this A and D. Look at this A and D. I am explaining you these terms. Okay. Now what about D? See this. Whenever I get the first LC, now this transferring or advising bank will issue the same LC. Same LC is transferred to the subseller. So that is known as D LC, transferable. But a real answer to this is not A, not D. What is green clause LC? Okay, I'll explain you that also. Red clause and green clause. The answer is between these two. Okay. So now the answer over here will be, how many of you can guess this? Is it A or B? This B or D? B and A already I have told you, not there. So the answer is B, red clause LC. Red clause LC is the LC which states that the seller or the exporter has a right to get the pre-shipment credit either from the buyer or from the bank. Okay, so that is known as red clause LC. Got it? Now what is green clause LC then? Green clause LC is a step ahead of red clause LC. Green equals to green clause, okay, LC, that is equal to pre-shipment, okay, means pre-shipment finance plus warehouse finance, okay. So that is known as this green clause LC, whereas red clause LC is only pre-shipment finance. So this is red. So actually to sum up, green clause equals to red clause plus warehouse finance. So here I want only pre-shipment. So the answer will be red clause. Okay. Which of the following statements are not correct in context of the NRO accounts? So not correct. We want not correct. Okay. It can be opened by non-resident or residents. Opened by non-resident or residents. Both. It can be opened as a joint account holder also with another non-resident. Okay. Accounts can be of saving or current only. None of the above. So what is the answer over here? We want not correct. Anyone? Yes, it is. NRO. Firstly, what is NRO account? See, there are two types of accounts. Okay, always remember NRE and NRO. There are actually more than two, but I am telling you for comparison. NRO. Okay. O is what? Non-resident external, and this is non-resident ordinary. This is known as external. External means the money comes over here from outside. Money comes from outside. That is known as external. Money comes from outside, USA, let's say. Okay. Money comes from USA into India, into that account. Okay. That is known as external. And NRO means the money generated from India itself. Money comes from India, my rent. Okay. From India only. Bharat we'll call it now. From Bharat. Okay. So my money comes from Bharat only. India, same country. Suppose if I am having some flat on rent, I've given some flat on rent, and where will the tenant give that rent to me? Where will the tenant give that money? The tenant will deposit the money in my NRO account. So what is the peculiarity of this NRO account? It can be opened by non-resident or resident? No. It can be opened by only non-residents. So this is not correct. This is false. It can be opened as a joint account holder also with other non-resident. Yes, it can be. Joint account holder can be a non-resident also, can be a resident also, both of them. So this is true. It account can be in savings and current only. This is a bit confusing. It's not only actually. It can be in term it can be a term deposit also, FD also. NRO FD is also possible. Okay, so we'll make this question as saving or current or FD. Okay, so now this is also true. So the right answer is only one, false over here. It can be opened by non-residents or residents. It cannot be opened by residents. It can be opened by only non-residents. Resident person can be the joint account holder in it. That is allowed. Got it? But the resident holder can't open the account singly. That is the point over here. Important point for thinking. Okay. See here, there are three types of accounts. One is NRE, NRO, and FCNR. FCNR means what? Foreign currency non-resident account. Okay. So in FCNR we have only FD. In NRE, NRO, let me show you over here. NRE. Oh, you got this answer now? It was A. NRE, NRO. We have all the three. Remember, saving, current, FD. Okay. And in FCNR we have FCNR. We have only FD. Okay, FCNR. Okay. We have only FD. So that is the difference. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates from IIB on JAIB and CAIB. Okay. Number two, you will be getting the free YouTube series. Right now, what are you watching? Free YouTube series. Okay. So right now, what are you watching? You are watching free YouTube series, Sankalp series, right? So similarly, you will get it on all the subjects. So that's why subscribe to the channel right now. Click on the bell icon, click on this like button, share it with your friends. Do it fast. Okay. Which of the following is not permissible credit to an NRO account? Here, not a permissible credit. To an NRO account, I want NRO now. NRO means what? The funds are credited from India. Means not only from India, they can be credited from outside also. But the point is the funds can be credited from India. Both of them it's allowed. Okay? So which of them is not permissible? Proceeds of the remittance from abroad through a normal banking channel. What is the problem? Let's see. Any foreign currency freely convertible during temporary visit to the account of the account holder. Means any foreign currency freely convertible. Suppose if I am an NRI, I stay in US, so I've come to India. So now I'm having some dollars with me. So can I deposit those dollars in this NRO account? Think over it. Again, this is the B option. Third one, legitimate dues of the account holder in India like dividend, interest, rent, etc. So can I credit this? Or is it D, none of the above? What do you think? Generally what happens whenever we get such questions, we always tend to think, everyone amongst you is tending to think now. You all are searching the answer within A, B and C only. Because you have ignored this D option, none of them. Okay? Never do that. The right answer over here is D, none of the above. Okay? Because all of them over here are permitted. Means what? Proceeds of the remittance from abroad through normal banking channel, it's okay. Suppose if I get the money through SWIFT, suppose if I get the money through TCs, traveler's checks, through suppose legal cash, so who can stop me? So proceeds of remittance from abroad through normal banking channels allowed. Okay, I'll write it true over here. True. We want false. Okay. Any foreign currency convertible during temporary visit of the account holder. So what is the problem? I'm an NRI. I've earned money over there. I'm having an NRO account with you. And I want to deposit that cash in it. I'm having a legal cash. Let it be in any currency. So it is allowed, but obvious. Okay. legitimate dues of the account holder in India like dividend, interest, rent, etc. What is the problem? That's what the reason for NRO is. This is the real reason for which NRO account is held in India. Okay? Because what happens in this is this dividend, interest, rent, these are the earnings which I'm earning from India as such. If I'm earning from India, where do I take it or should I leave it? After all, it's my money. So that's why this is credited to NRO account and the answer is true again. We want a false answer, not a permissible, right? So this is none of the above. All of them are permissible. Okay. An existing resident account is converted into non-resident ordinary account when the person resident in India leaves India to live abroad in any country. Check it. Option number B. When the person residing outside India only makes a request to designate the account as an NRO. Okay. Makes a request to designate the account as an NRO. Okay. I'll explain this. When a person resident in India leaves India to live abroad other than Nepal and Bhutan and all of the above. Now tell me, what is the answer? Kindly consider D option also. Don't ignore this, okay? Because we tend to ignore these small answers or all of the above, none of the above. Never do that, okay? The correct answer is, who can tell me? Okay, let me explain you this. When a person resident in India leaves India to live abroad in any country, what does it mean? Suppose I am a resident. Right now I am a resident in India. I get a job in USA. So I want to go to USA now. Okay? So what happens? I come to your bank and say that, sir, I've got a permanent job in USA and I am going there. So this is my savings account. What to do with this account? Should I close it? What will be your answer? Because I am an NRI, now I'll become an NRI, right? When I go there. So what will I do with my savings account? So I've come to you before only. Before going, I've come to you. Sir, do something. Madam, do something. In that case, what will you do? Yeah. This is a case given in A. When a person resident in India leaves India to live abroad in any country. So at that time, when I am leaving, I'll come to you and tell you that, see, I'm getting converted to NRI. So now you convert my savings account to NRO. SB to NRO is allowed over here. NRO, not NRE. Remember, NRO, not NRE. Option number 1. Now B. When the person, what do you want, right or wrong? Right only, yes. When the person residing India, outside India only makes a request to designate the account to an NRO. Okay, remove this only. When the person resident residing outside India makes a request to designate the account as an NRO. What does this mean? Sir, earlier case was what? I was leaving India. I have to leave India and then I am coming to you. Second case is I have already left India, Bharat. I have already left Bharat now and I am staying in USA since last 2 years. But I am having one savings account with you. Actually, as per the rule, NRI should never have the savings account. But I have not told you. How will you know? Simple logic is that. Suppose if I go to USA, who will tell you that I have gone to USA? You won't come to know. In that case, what happens? Suppose I am residing in the USA and now I know that, remember that, yes, I was holding one savings account with your bank. So what will I do? I'll come to your branch. Whenever I come to Indian visit or Bharat visit, okay, whenever I come to Bharat visit, I'll come to your branch and tell you, sir, ma'am, this savings account was there. Now I am an NRI and I'll give you all the proofs, visa, stamping, everything. In that case, what happens? This person, when I am requesting you to convert my savings to NRO, you have to convert it. So in that case also, this will be allowed as savings to NRO. Okay. So if once I go ahead, means abroad, and then I come back and request, then also you can do it. When the person resident in India leaves India to live abroad other than Nepal and Bhutan. So this is correct. Nepal and Bhutan, here, other than Nepal and Bhutan, if I go to Nepal or Bhutan, then I'm not considered as an NRI actually. Okay, because I have to, I'm considered as an NRI, but the problem is the savings and current account are not getting transferred. They remain as it is. So the answer is D, all of the above. Okay. Next, everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material, plus live classes, ebooks, tests, whatever we require for clearing CIB over here, we get it over here. We require mainly three things here. Remember, keep it basics. Okay. We require three things only. One is classes, second is this test, and third is the books, right? These three things are enough for you. So all of them are available on Adda 24/7 app. Why are you wasting the time here and there? Immediately download it and start reading. Exams are near, isn't it? Pre-shipment credit can be sanctioned by a bank where the following conditions are satisfied. Which one is not correct? My God, such twisted questions are asked. Not correct, huh? So we want not. Which one is false? We want it, right? So pre-shipment credit can be sanctioned by a bank where the following conditions are satisfied. Which of the following conditions are satisfied? Now we want false one. Huh? It can be allowed for purchase, processing, and manufacturing goods for shipment. For purchase, processing, see here, processing is there, or manufacturing goods, right? For purchasing raw material, it means it's allowed for purchase, processing, or manufacture of goods for shipment. It can be allowed on the basis of confirmed order. It can be allowed on the basis of LC in his favor, his or her, in favor of some other person. It cannot be on the basis of order for rendering services only. which of them is not correct? First one is correct because it is allowed for purchasing raw material, that labor, manufacturing, everything. Just now I told you in the first question itself. So this is true. What about the second one? It can be allowed on the basis of confirmed order. Obviously, see, if you are a bank and you want to finance somebody, won't you check the authenticity? Suppose if I come to your branch tomorrow, sir, ma'am, kindly give me this pre-shipment finance. You'll say, what, on what basis? You'll see some order, isn't it? So that is true, right? Next one, it can be allowed on the basis of LC in his favor, his or her. Never be gender biased now. It can be a female. Female can be a big entrepreneur now. We have seen many examples. So, credit in his or her favor or in favor of some third party. That is also allowed. Third party means some other person. This is known as transferable LC. This is a case of transferable LC only. Okay. So, in this case also, we are allowing this pre-shipment finance. But that is only to the level number 1. Beyond level number 1, we are not allowing. So, this is also true. So, which one is wrong? All of them are true. We want false. So obviously last one will be false. But what is it logical? It cannot be on the basis of order for rendering services only. Means what? If I have to give some service, can't I get the pre-shipment finance? Obviously I can. So this is false. India is now service economy, isn't it? We are more than 50.
Hey everyone, a very good morning to all of you. Welcome to the Office of Adda 24/7, the special session of your BRBL subject in the English medium language. And first of all, happy Raksha Bandhan to all of you. Happy Raksha Bandhan to all of you. So today is the festival, so just take a pledge that from today, because you know that from 1st of September, your CIB registration date is going to be start. It means from tomorrow, right? From tomorrow, your CIB registration is going to be start. So what you have to do, simply, first of all, today is the last day in which you have to think that which elective subject you have to select, right? So first of all, just prepare yourself that which elective subject you have to fill tomorrow so that you can easily understand that elective subject, and you can score easily 60 plus marks. So today is the only day in which you have to select the elective paper. You can ask the teacher, you can just see the video courses of all the elective papers. So many things are there in this one. So it's on you that whether you have to select according to your choice. Okay, what is my opinion, what is your friend opinion, it is none of your business, because you have to think yourself that which elective will be suit to yourself. Because suppose if your background is a BTech one, if your background is a BTech one, then you can easily select the IT one. And most of all, student, select the HR one. Why HR one? Because the mostly 60% syllabus that is already covered in ABM and ABFM. So that's why students select the HR subject as an elective. So it's on you that what subject you have to select. Okay, so today we are going to solve the questions of Limitation Act and the tax law. Okay, so one by one we will do the question so that you can easily understand. Limitation Act, what is Limitation Act? That what is your limit? What is your limit? It means basically, suppose X person is there, Y person is there, X person breached the contract. So if X person breached the contract, so in that case, what will happen? In that case, if the X person breached the contract, so Y have a right to file the case. So if Y will file the case, so he have to file the case within the 3 year of the day on which it's breached. So from that day up to 3 year. So Y have a right to file the case. So what is this 3 year? 3 year is called limitation period. 3 year is called class, that is limitation period. That's it. Okay, so in this Limitation Act, when you just read in the paid batch, so in the paid batch also you have to focus on the chart in which the various acts are there, because as you know that this limitation is applied to the suit, limitation is applied to the appeal, and limitation is applied to the application also. So in these three things the limitation is applied. So that's why you have to focus whatever the suit, whatever appeal that is given in the chart, and the application date also. So each suit, appeal and application have a different limitation days. And if you talk about the tax law, so in the tax law we basically have to understand what? We basically have to understand in the text that about the Income Tax Act, Income Tax Act, right? The second one is your income tax, second is about GST, then your PAN card and commodity derivative tax. So these are the four total segment that you have to read in the tax law. So I think this is clear to all of you that what you have to basically understand and read in the limitation and tax. So this is a part of the module C. And as we know that if you cover module D and module C, so 60% syllabus already you done. Okay, now let's start with the first question. Number one question on the screen is that what is the period of limitation for filing a suit for compensation for the breach of partnership agreement? 1 year, 2 year, 3 year and 6 year class. Tell me. Yes class. What is the limitation period for filing a suit for the possession of movable property by the person dispossessed? Suppose this is X person, okay, this is Y person. X person have a movable property and Y person have taken that property. Y person have taken that property. So in that case, what will happen? X have a right to file the case. X have a right to file the case. So tell me in that case, what is the limitation period when the breach means violation. So when the violation of partnership agreement will be done, so what will be the exact this one? Tell me, class. Yes, class, tell me what is the right answer. So for that thing, the right answer is 3 year. Okay, 3 year is the right answer. So just remember this one, because in the limitation act now these types of question will become. Okay, next. The next question is, class, as you can easily see that the limitation period for filing a suit for possession of movable property that is dispossessed. If the movable property is dispossessed, so what is the limitation period? 1 year, 3 year, 6 year, and 12 year. So in that case, class, the limitation that is for filing the suit for movable property that is dispossessed. So basically that is 3 year is the limitation period. So for the second one, 3 is the right answer. Okay, second one, 3 is the right answer here. Okay, next. Next question is, in the case of suit, okay, for the recovery of possession of immovable property. What is immovable property? Property that cannot move from one place to another. This is called this one. Okay. So if the suit for recovery of possession of immovable property based on the title, if the plaintiff has been dispossessed, the period of limitation will be 6 year, 12 year, 30 year, and none of the above. So what is the right answer for this question? Tell me, guys. So for this question, the immovable property, the basically the limitation is 12 year. So this is the right answer. Okay, 12 year is the right answer for this question. Done. Next. Next question is, class, that the limitation period for filing a suit for specific performance of a contract in the case continuing breach is calculated from the date is. So first of all, guys, we have to understand that what is specific, what is specific performance of a contract. What exactly this means? Specific performance of the contract. Suppose in every contract class, as we know, if there is a breach of contract now, so we have to give the compensation to the opposite party. I think this thing you know right now. We have to give the compensation to the opposite party. But in that case that you are seeing in this, okay, but in the specific performance, suppose if one person breached the contract, so compensation is not the only way that can fulfill the demand of this one opposite party, but the person want the specific performance that you have to perform. You have to give me my this book only. You have to perform this activity only. So then only this contract can be happen. This is called the specific performance of the contract. So in this question, it was asked that the limitation period for filing a suit for specific, that is of a continuing breach, is calculated from the date. So when it will be calculated? It will be calculated from the last breach of contract, from the first breach, from the discovery, or none of the above. Yes, guys. What is the right answer? So in that case, from the first breach, the limitation will be start. So for the fourth one, B is the right answer. Okay, B is the right answer for the fourth question. Done? Now, let's start with the fifth one. In the fifth question, that is, what is the period of limitation for filing the suit for recovery of possession of ancestral property by the co-sharer? It is 12-year, 6-year, 3-year, or 30-year. What is the exact answer? What is ancestral property? So guys, ancestral property is basically, this is grandfather, the property will be now come to the father, and then the property will become to the son. So this is called ancestral property. So what is the period of limitation for filing the suit for the possession of ancestral property by the co-sharer? Suppose two son is there, S1 and S2. So suppose if there is a suit for recovery of possession by the ancestral property, S1 have filed the case. So what is the limitation period for this one? Tell me. What is the limitation period for this one? For the fifth one, the limitation period for the ancestral property is 12 years. So fifth A is the right answer. Okay, next. The period of limitation for relating to the suit relating to immovable property for foreclosure of by the mortgagee, whether it is 30-year, 12-year, 3-year, or 1 year. What is the right answer? Yes, class. And what is foreclosure? Foreclosure is basically, suppose two persons are there, right? This is A person and this is B person. Two persons are there, and foreclosure means, suppose A person have given the immovable property as a security, right? Immovable property as a security to the B person. So in that case, suppose if A is not able to pay the money now, A is not able to pay the money. So in that case, what will happen? The B person, first of all, he will just possess that property, and then after possession, what he will do? After possession, he just try to sell it, okay, so that the money can become. So for that thing, what is the limitation period for foreclosure of the mortgagee? What is the period of limitation for suit relating to immovable for foreclosure of the mortgagee? So guys, for the foreclosure of mortgagee, the right have to learn. C class. Simply for the movable, just remember 3 year. For immovable, remember 12 year. And for immovable, if it's talk about the foreclosure, so it is 30 year. So just please remember these 3 acts. Okay, now the law of limitation only bar the remedy but does not extinguish war, debt, right, property, and recovery. What is the right answer? The law of limitation bar remedy. It means that after 3 year, after 12 year, if we just approach, so the court will dismiss the suit appeal application. But it will not extinguish what? Debt, right, property, and recovery. Tell me, class, I have just given you the hint. I have just given you the hint. So for seventh thing, the right answer is right. This is the right. The limitation for filing a suit by surety against the principal debtor would be 3 years from the date on which. So this question is basically principal debtor, this is creditor, this is surety. So this is contract of guarantee, section 126 of the Indian contract. So if principal debtor is not able to pay the money, the surety will give. That is called contract of guarantee. So when this question, it was asked that the limitation for filing a suit by a surety against principal debtor would be 3 years from the date on which the amount was paid by surety to the creditor, the date of demand by the creditor, amount become payable to the creditor, and refusal by the principal debtor to pay amount or notice being by the surety. So what is the right answer? Yes, class. What is the right answer here? So for this class, when the amount is paid by surety to the creditor, in that case, this thing will become. So for the eighth one, A will be the right answer here. Okay, next. Period spent in prosecuting the case before consumer forum can be included, excluded, and partially included. What is the right answer? See, the period spent in the prosecuting, this one will be, that is excluded. Okay, so for the ninth one, B will be the right answer here. It will be excluded. And in the page class, we have already done that. What things can be excluded? Okay, next. In computing the period of limitation for an appeal, the day on which judgment pronounced shall be excluded, the day on which judgment pronounced shall be included, the time taken for preparing the decree will be included, the day on which judgment pronounced and the time requisite for obtaining the copy is excluded. So if you have remembered that what things can be excluded, you can easily do that. So for this thing class, D is the right answer. Okay, D will be